Hello, hello, everyone. Hello, sir. It's
Hi.
nice meeting you again.
Yes, once more, we're
So,
back.
right. Good evening, everyone, and welcome to another power pack episode of Decoding Market in 3 moves. So, I'm thrilled to have with us today Mr. Rohit Srivastava. I think so. The man needs no introduction in the world of market analysis, right? Founder and strategist at Indiacharts and the brain behind Strike.money. Every week in this series, we break down the chaos of the market into three clear, actionable moves. So you know exactly where the trend is, where the traps lie, and where the opportunity is building up next. So buckle up because in the next few minutes, you're going to hear sharp insights, deep chart analysis, and Rohit's unique take on what really moving in the India market this week. So let's dive and decode the market in just 3 moves. So, hello, sir, and welcome to our episode once again.
Great pleasure with all your enthusiasm to take on whatever you're going to throw at me next.
Yes. So, going forward, let's deep dive in the first question. So, what's your current view on Nifty, and are we setting up for a deeper correction, or it's just a pause before the next leg up?
This week we are breaking out. So I don't know how the question of a correction even comes up. If there was a case for a correction, it was there 1 week ago when we had not crossed that 61% retracement of the very small fall that was there. So that was at around 24,980 or something like that, that level. So that was sort of the point at which if it had to turn down, it should have turned down. Now, moment we crossed that, it was game over as far as being bearish is concerned. And that happened, I think, on Friday itself, last Friday. That was the first warning sign. Monday was the last chance to get out of the short side for anybody who was trying any near-term shorts for a correction. We were only looking for that potential key. Okay, maybe if this is a wave 2 correction, we'll get worst case scenario. Can we break 24,500 and get to 23,500? But like I said last week, that got ruled out. And what we've been looking for then is the start of wave 3. Already happened this week. Correction? Now it's a joke. Now the word correction becomes a joke. So I in fact ended up writing this poem on 2 days ago and put it on Twitter. It just dropped in my head and I just put it out. But that was essentially the idea that that's it. I mean, all the bearishness, all the news has been absorbed. You had the wars, you had the tariffs, you had everything. Ab kya? You need something new to throw at the market. And if all of that could not get it down more than 400-500 points, then you just imagine what happens next. So no, there's no correction. So the word has been
Oh,
banned.
so it's absolute, like it's gone from the market totally.
Yeah.
Next, going to the second question, sir. With the recent moves in PSU banks and mid caps, do you think the sector rotation is real or just a short term noise?
No, sector rotation is always real. The hard part is being able to judge what that rotation is going to be. Of course, with the tools that we have in Strike, to some extent, you can actually study using RRG where the rotation is happening. So use the RRG graphs to look at whether a sector is weakening or it is strengthening. Is it going up vertically from left to right, or rather if it's going up in this angle, which is like the 45-degree angle, it sort of means that it's outright taking off both on momentum and relative strength. So rotation happens, it's a reality, and each time we try to judge what the potential sectors are that will lead from the front, sometimes by looking at the relative behavior during the correction. I mean, what fell less may go up more, that is one angle, but the RRG graphs give it a mathematical context of both on momentum and on relativity, what is really gaining strength. So uh, I don't know if I've gone off the mark, but rotation is rotation. It's part and parcel. We've seen so much rotation. In fact, I think we are seeing too much rotation. So we are getting, but it's been like this for the last several years now, and we just have to digest it that this is how the market is. I'm not sure. Sometimes I wonder whether it's got to do with the options market, because there is something known as options volatility, especially in stock options, where if it moves more than a certain amount in a particular month, then the writers who provide the liquidity don't benefit from the game. So what ends up happening here is, and it's too much to think that this is a conspiracy, but you get some stocks that move up a little bit, then you get others which move up a little bit, and others which move up a little bit. In the end, the net gain in individual stocks is limited on a month-on-month basis, even though they continue to trend. But the index gets the benefit of the rotation the most, because no matter if it is Sun Pharma going up, or in the last 3 days it has been Reliance Industries from nowhere, the Nifty continues to benefit. So standalone, I think, and so this is an insight for people. I try, putting out trades in stocks and index, and I in the end realize that if you just stick to index, it's more than enough, because you can spend too much of your time trying to judge the rotation, and it's not easy.
So, moving to the third part, like if you had if you had to make three clear moves in the current market environment, what would they be and why?
Now, when you say three clear moves, meaning what? What kind of moves?
So, it can be related to diversifying your capital into the market. So, what will the three steps that will you take at this current market scenario?
So then you're saying for investors.
Right.
So if investors, if they're still sitting on cash, get deployed, I mean, before the DIIs deploy their cash. Because the simple thing here is that now that the market is out of that range, and as it continues to trend higher, it's going to force everybody to deploy. Okay. This forced deployment means FIIs, DIIs, everybody who's sitting in cash, who's not allocated in non-dollar assets, is all going to jump in and start allocating. Now, either you buy first or they buy first. So this is now becoming going to become a chase to the moon. So if you're still sitting there and waiting, then you'll just end up being later and later in this ride, which has just started. Have I given three moves or just one?
So you have only given one move.
So one
So
is
at
get
this
invested.
for yeah.
One is get invested. Second is stop shorting the market on every rise, because your question started with where is the correction. So for the traders, don't short. Forget it. Your strategy should be buy, exit, buy, exit, buy, exit. Mandi lagta hai, exit. Don't short. So that is the lesson of the month, because we didn't get that correction to 23,500. So it was too small and not worth it actually. So this is a buy the dip market. Treat it accordingly, whether you're trading or investing. So that is the second thing. Third thing, stick with the winning sectors that were winning for the last couple of years. So whether it is mid caps that were performing last year, now they will perform again. Whether it was defense that is still performing, will continue to perform with whatever corrections that may happen in between, or whether it is your power related sectors, whether it's your metals, your PSUs, everything that was doing well will continue to do well. Now you can argue what will do better than other, and that's usually requires more analysis. You can simply chase momentum and beta, and try and make the right choices by picking it based on statistical data, which is why again it brings us back to strike, that are you taking your decisions on gut feel or is it data backed? So if I say chasing momentum, are you scanning stocks for which have had the best performance over the last, a couple of years and held out better than others? And then are they the companies that are showing growth? So then you do a scan on the fundamentals as well. And then when the two layers come together, then you have stocks that make sense for high growth, high risk, high return, reward kind of output. You can always go defensive, but yeah, that defensive will only ensure that you make lower returns.
So talking of the traders, okay. So as we know that there is no chance of correction and all, we have already forgotten about corrections. So coming to the traders, what is the biggest mistakes traders might make in the current phase of the market?
Trying to trade for small moves, it's called pennies on the dollar. So for example, trying to pick 300 points up, 300 points down when you're actually inside a 2000 point rally. Okay, so that means that when you're in a move, you need to trail your stop loss and ride the move. That is where the biggest gain comes sometimes, and you have to know when to do that. So you can't, if you just keep doing entry exit, you're out and the market is gone. Now you won't get a second entry. So when the big move comes along, you have to have the mental fortitude, as written in these notes by Prechter. One of his fourth points was have the mental fortitude to accept big gains. So accepting big gains is something that sometimes people forget. We only think about cutting quick losses, and then we end up cutting quick gains also. And then the big gains never come. So then what happens is the amount you paid for losing money, you don't earn it back. The only way you can earn your losses back from the trades you make in a trading short term range, where 200 पॉइंट के रेंज में मार्केट अटका हुआ था, 2-4 लॉन्ग शॉट कर दिया, इतना लाख रुपए लग गया. लेट्स टेक अ रियल एग्जांपल. बट वहां से 2000 पॉइंट ऊपर गया तो मैंने 300 पॉइंट में काट दिया. सो क्या फायदा हुआ तुम्हारा? जीरो अंडा. I have put it in very simple language. So if you don't ride the big wave when it comes, then you don't get paid back for the pain you took in trying to figure it out. That is it.
So
That's it.
Just one last question about the global markets. Okay. So if you see the dollar and all, okay. So what role do global markets like the US indices or dollar index play in the current Indian outlook?
No, they play a very big role. That's a good question. We spent a lot of time discussing macro, and recently in my long short report, I said this time I'll not discuss it, simply because we go back and forth then on the same thing. But some of the things that we've been saying longer term is, one is that the dollar at some point enters a larger bear market. Second one, that the interest rate cycle turns down meaningfully, especially for India. We are at the cusp of where the rate cycle for US, which has a direct impact on the dollar, is actually due to turn and is giving signs this week, because the bond market, US bond market 10-year note, I wrote a note on that also, which I've sent to you, and I think probably will go social, which is basically that the bond yields are falling. Now that has a direct implication for the dollar falling, and our falling dollar basically means that non-US assets become more attractive for some asset allocators. And that means money flows somewhere out into markets like emerging markets, Europe, China, and so on. And it does benefit commodities as well, which is why we talk about the metal sector and the commodity cycle. So many things, there's so many things that get triggered by the dollar and the bond market. I'm saying a combination because, there's something known as risk off and risk on. Risk off is essentially when you have a rising dollar and a falling bond market is the worst, is one type of bad. That is the type which is inflation, what we saw in 22-23. But the real risk off is when you have a falling dollar and a rising bond market. Sometimes can happen when there is extreme fear. Okay, and that extreme fear then gets triggered into creating demand for bonds and a weak dollar environment. But at the end of it, at the end of these fear trades, you also get the liquidity overhang that comes with the weak dollar, and that eventually triggers the reversal. So you have to keep that in mind. Where are you within that? Is it a risk on or a risk off kind of a setup? And that at a global level, especially for global money. Now in India, what has happened is that we are significantly become dependent on domestic flows, and to that extent, sometimes these global readings are okay. They play a part. I mean, we are still somewhere correlated, but there are times when we've done our own thing. Like even the correction we saw from September last year, it looked like our own thing because we are not falling with US equity. But if you actually look back, and I saw it later in November, December, and posted a chart, it was directly correlating with the rising dollar and rising bond yields for the first 3 months. So there was it was happening. It happened exactly like around started the same time, and the moves were so correlated till January that it was an important signal. So there are signposts there, but there's in this also you have to segregate the long term and short term. See, sometimes you can get obsessed with a move in the dollar which is more long term, but it may or may not have short term implications. So it can diverge sometimes in the short term. So you have to look at the market that you're studying for those immediate moves. But it does help you having a big picture of what is happening on liquidity globally.
Got a good picture of overall what's going on. So that's bring us to the end of this episode of Decoding Marketing 3 Moves. So let's move on to the viewers and pick 3 questions that are there. So the first question that we can see is from Deepak.
Kindly share your views on NQ at ATH. What is NQ? Nasdaq?
Just
Yeah, it is Nasdaq for the IT sector.
yeah.
I'm not exactly an IT sector fan, unfortunately. Though the Nasdaq and the IT sector should be correlated. So fine, it will do well, but other sectors will do better. So I will not put money in IT personally. But I mean, except if you have a bottom up kind of a IT stock that you think is in the mid cap IT space and can possibly give you growth. If you have that kind of an idea, then yes, that would be like one idea or something. But apart from that, I'm not large cap IT. I generally avoid. So, but that doesn't mean it won't go up with the Nasdaq. It only means that I think in a growth environment, there are higher growth sectors. That's all I'm trying to say.
So moving forward is
Metal index is a breakout point, but yet to break out. What's your expectation? Is it wave three? Yes, I think longer term it could be wave three of three. Longer term meaning starting from the COVID lows. We could trigger a third of third. I am waiting for even the Bloomberg Commodity Index to confirm that, but that will lag a little bit because it is being bogged down by oil. Similarly, copper seems to be leading the way. You saw the copper price movement yesterday for the start of third wave, but we still don't have participation clearly from maybe a nickel and a zinc. To some extent, you're seeing aluminum pick up, but I'd want that also to break out. So, a couple of things falling into place for a third of third wave. Some more confirmations needed at the metal and commodity side, but it looks like that if we just look at the Nifty metal index, that the next move up should be a three of three.
so another question is there regarding RMI.
RMI scanner, how to avoid false daily new buy signals, which would be best daily new buy setup? The answer is combining it with the weekly. So one way of filtering out bad ones on the daily is overlay of the weekly. So that's why we have the multi filter setup. So what I'll usually do is say on weekly whatever is giving buy and new buy, combine that with the daily new buy. So when you have that combination, then you're only looking at buys which are already confirmed on the weekly chart. The chances of whipsaws are fewer. This logic applies on any time frame. It's a very short term trader doing daily and hourly. Same logic would apply. where you combine the daily and hourly. So you are then looking at setups for the short term, but which are confirmed on the higher time frame. So basically, the higher time frame is the confirmation where the trend is already in force, and the lower time frame you're trading that trend.
So let's here we come to the end of the session and also the end of like questions. So thank you very much, sir. Very big thank you for breaking down the complexity of the market with such clarity and precision. If you found value in today's discussion, don't forget to like, share, and subscribe, and stay updated with every episode of Decoding Market in 3 moves. And if you haven't yet explored our market tool and insights, go and also take a look out of Indiacharts.com and strike.money. Until next time, trade smart, stay curious, and keep decoding the market with us. Thank you.
Thank you.